There are many ways to estimate the cycles in Bitcoin. There are moving averages that measure the momentum. There's the realized price, an on-chain metric that measures the average cost basis. There's all kinds of approaches. If we combine them, we get a very interesting indicator. This here is the CBBI. This is a very long-term chart. It shows the Bitcoin price on a logarithmic scale. And the CBBI is this oscillator that goes between 0 and 100. Now, what is this? It's a combined metric of several approaches. A momentum indicator, like the pi cycle top indicator. We've got the realized and unrealized profit and loss. We've got an activity measure, the realized hodl ratio, how much trading activity is currently on the blockchain. We've a measure of mining profitability. We've got a measure of momentum, the moving average. Another approach to estimate Bitcoin's current price relative to the historical trading range. So this is close to the logarithmic regression approaches. Market value to realized value z-score is the degree to how much the average market participant is currently in profit or loss relative to the volatility. We've also got the reserve risk. We've also got an on-chain metric looking at sell pressure of the very long-term investors. So there's all kinds of approaches that historically work pretty well. When we combine them, we get to the CBBI. Now, why is this useful? First of all, it worked extremely well in the past, as in it did give us selling signals whenever Bitcoin was extremely heated, but it also told us at what point a bear market might turn around. What I find fascinating about this chart is that it puts the current correction into perspective. It shows us that this might just be the beginning. If we get into a full-blown bear market, then we might fall much, much lower. The question is, what are we going to do about this? Because there's a very good chance that the crypto market is simply maturing and that over time the movements to the upside but also to the downside diminish. As in, when we just look at how much the net unrealized profit peaked from cycle to cycle, we might just be at a turnaround point again. We saw a double top over here, another double top here. This could also be interpreted as a double top because this second rally brought us to 72K, so slightly higher compared to the 69K. And what we're currently experiencing could be interpreted as a triple top. So again, from 70 something K to 100K to 125K. And the big question is, if this is the thesis that's going to play out and we are about to enter a bear market, what should we do? And how much could we fall? In the past, we fell below the long-term holder realized price. So the average cost basis of the long-term holder. That happened in 2015. After Silk Road and Mt. Gox collapsed. It also happened in 2018 after the ICO bubble burst. And it happened in 2022 after Terra Luna and subsequently FTX imploded. And so, are you prepared for a potential scenario like this? If Bitcoin was to fall below 37K, so maybe it turns around at 35 or 32 or maybe just 30K, would you be completely crushed with your net worth? Or do you have a potential plan B? Because here's the problem. If we look at alternative asset classes that aren't that much correlated to Bitcoin, so we don't want to buy altcoins, we don't want to buy Ethereum, we want to buy something that doesn't move in sync with Bitcoin. If you look at those alternatives, it's not that easy to find anything cheap. Because here's the problem. This is the historical PE ratio of stocks. Stocks are, and this is a very long-term chart, right? This starts in 1871. Stocks are close to their historical all-time high. What we saw over here, that was the dot-com bubble crash. What we saw over here, that was the global financial crisis. So stocks relative to their future earnings are incredibly expensive. And that's in the end what we buy with stocks. We simply get the future earnings. Stocks relative to the monetary base, relative to USM2, are also very expensive. This chart starts now in 1959. We are at comparable levels to the peak of .com, and now many people talk about a potential bust of the AI bubble. Stocks really are much more risky than most people think. Relative to the monetary base, they can fall by 74% over here, or by 75% over here. And yes, in US dollars, the drops aren't that bad. And yes, in US dollars, we get bailed out much quicker. But in the end, the reason why we buy any investment is to get more purchasing power in the future. So we have to put the stock performance in relation to how much the monetary base is expanding over time. Without that monetary base adjustment, we just see a chart like this. The S&P 500 just going straight up all the time. We get bailed out very quickly. But really, if you bought in the year 2000 and then you have to wait 13 years to get your money back, at that point, the US dollar is worth much less and you have lost purchasing power. There's of course a potential alternative to go really risk off, to buy gold, for example, but gold has appreciated massively as well. Here's gold relative to the money supply. The dotted line shows the average ratio since the beginning of this chart in 1959. So the current gold price is roughly 50% higher than it should be historically. By the way, if you so far enjoy this content and you don't want to miss future videos, then feel free to subscribe. I publish videos regularly over here. It might even be more problematic. We have seen a turnaround point at similar price levels in the past, but the top that we see here compared to the prices today, that's a decline of roughly 60%. That happened over the course of 45 years, and unfortunately the gold supply also grows over time. There's no static gold supply. There is roughly a 2% supply expansion per year for gold. And so the 60% decline is equivalent to a 2% supply expansion. In other words, if we were to compare the gold market cap with USM2, with the money supply, then those two tops would align very, very well. And so maybe gold is already more than 270% above its fair value, above what it traded for historically. So stocks are super expensive. Gold isn't that cheap either anymore. And so really, what's the potential alternative? What about property? Property prices are also not that correlated to the rest of the market. Of course, if we see a massive sell-off, like we saw during the global financial crisis, this can have a spillover effect to stocks as well. But in general, during regular times, the assets aren't that well correlated. Here is the US House Price Index, as officially published by the Federal Reserve. Here is the US House Price Index relative to the money supply. Again, we see the global financial crisis, and the entire recovery that we saw in prices was just money printing. House prices did not increase much in value since then, only by 10%. Houses tend to just keep pace with monetary expansion, and they do so again. And they might not be that overvalued, relatively speaking. Here's another house price index. This is by Standard & Poor's. And again, it shows a very similar development. Property might not be too expensive. At least if you compare this to the crypto market, which might be very elevated, which might sell off quite aggressively. And if you compare this to stocks, and if you compare this to gold. Construction for houses is coming down. The median sales price for houses haven't really changed in the last 3 years. But the monetary base did go up. So in other words, relative to the monetary supply, we have seen a correction. Here's the average house price, not the median, that tended to be flat. It didn't go down as much. But in general, the market for housing still seems to be comparatively healthy. I'm always talking about monetary debasement. Here's what I mean. Over the last 66 years, the money supply grew on average by 6.8%. So that's how much the US dollar is really devaluing over time. The official inflation rate is 3.3% on average over that time frame, but the inflation rate just measures consumer prices, and consumer goods tend to be deflationary in nature long term. They tend to become easier and easier to produce because we advance our technology. So if there was a stable monetary base that wouldn't expand, then over time things should become cheaper and cheaper. But because the monetary base expands faster than our productivity grows, that's why we see a consumer price inflation. But really, if we had a stable monetary base, things would become cheaper. 6.8% is our hurdle rate. And this is the potential opportunity with property, because now our interest rates are coming down. If we can lock in a very long-term mortgage and we can finance a house with 80, 90 or even 100% debt, then we are going to long-term devalue that debt. This will be a winning trade because we are paying less every year for that debt compared to how much the debt is devaluing. So the delta is the profit that we make. The more debt we have, the more profitable that trade becomes. So I do expect in the not so distant future with declining interest rates that there will be more demand for property again. Now, property in itself doesn't return that much, as in the rental yields aren't that high. But again, if we can finance property very, very cheaply and we can lock in that low interest rate, at the same time the monetary base expands by 6.8% per annum, potentially even faster if we are really worried about the US dollar becoming worth less and less, and if we really worry about that the high debt burden in the USA becomes even more of a problem. If that's our main thesis, then having a lot of debt that devalues over time and buying something that keeps somewhat its value is a winning strategy. And so it could be that easy. We can simply just take some profit from Bitcoin, also take some profit from our holding in Nvidia stock, use that for a 10% down payment on a house, and then finance the remainder with low interest rate and long duration. And then, of course, as interest rates fall further and further, we can refinance. But currently prices are comparatively quite attractive. Not relative to the yield, but relative to the money supply, relative to how much money is currently being printed. And if you're quote unquote lucky, there might even be a shortage of housing since construction is currently coming down. If it's your very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. Feel free to also check out the premium membership. The link is down below. It's thebitcoinstrategy.com. I discuss the topics mentioned in this video in more depth over there. I of course also share my own trades. I share how I'm setting up my portfolio. So see you on premium. The link pops up over here, or see you next time on YouTube. Cheers.